And whoever the host is, Kate, are you the host? Or
I'm not the host, but
all right, because
he is. He's recording. He's recording.
Hi, everyone. Welcome to the Chicago Hero Hacker House. We have Jarry Xiao here from Solana to give. Actually, you know what, Jarry? Why don't you tell everyone what you're going to talk about?
Hey everyone, I'm Jarry from Solana. Today I'll be talking about central limit order books in Solana, starting with how Serum operates. And then I'll be discussing a little bit more about how you extend Serum to represent products like derivatives. I did a lot of work earlier in the year on a contract called Dexterity. That sort of builds upon the native Serum primitive. But before talking about that, I want to give a brief overview about how Serum works, like why it's cool, and then what the limitations are of that contract. So Serum is a central limit order book. Usually we call those clubs, right? The way that this works is it's a way of essentially representing market prices of whether, like, what you want to buy and what you want to sell. So suppose I have this table here where I have price in the middle column. We'll just write prices down descending. We'll start 15, 14, 13, 12, 11. Usually the way that this is represented is that like you'll have people who want to buy at certain prices, those are called bids. And you'll have people who want to sell at certain prices. Those are called offers or asks. And generally, right, like people will place these orders when they don't see a price in the book that they don't necessarily find like reasonable based on what they're looking to do. So say someone wants to buy like 100 of some asset at $12. Say this is like, say that this is like SOL or like some token, like we'll call it like X USD. So the price that's listed is in terms of USD for buying 1 unit of whatever X asset is, right? So here, this would be representing like you want to buy 100 X at $12. So that would be like a bid at 12, and say someone wanted to sell at 13 for like 50. This would correspond to like, I want to sell, or 13, right? So here, sell 50 at $13, right? So this is the typical like way that an order book is structured. You have different price tiers, and you have different types of orders like bids and offers or asks. And then usually the book will have like more depth to it too, right? Like maybe someone doesn't want to sell at 13, but they're willing to sell at 14. And you have another order here for size 100, maybe like 200 here. And then the order book kind of just goes all the way down, right? So this sort of represents like people's propensity to like buy and sell a certain asset, and it gives the current state of the market, right? Because the idea is that like, in this particular example, I know the market is somewhere in between 12 and 13, because otherwise there would have been a trade that occurred, right? So like if a person has 100 bid at 12, if they were really willing to buy at 13, there's 50 people that would be, there's 50 open offers that would be willing to match that particular interest there, right? But because they're not willing to cross this spread, right? Or they're not willing to like buy this offer or this asks, they instead put a bid at 12, right? So this uniquely represents the market. The market is somewhere like 12 at 13. And this is a data structure, right? You can imagine like in computer science world, you can represent this in a program, right? You can represent this ladder prices in some sort of like data structure and build logic around how to process that. So this is essentially what Serum does, right? So Serum basically builds a way to like process this order book data structure and also trades that occur against it. One important quality is that you want to sort of have like price time priority. So if, for example, I want to sell against someone in this market, the best price that someone is willing to buy for is 12, which means that when I sell against the order book, the price that I get filled at, the price that my sale goes through is $12. The other important factor is that on each of these levels, there's likely multiple different orders that compose that level, right? So here I had like 100 at 12, and I had 200 at 11. This 100 could be composed of multiple different orders, right? So say instead of like 100, it's represented in blocks of like 50 and 50, right? So the size on the level is still 100, but it's composed of like 2 different order blocks, right? And say this was inputted by someone called A, and this was inputted by someone called B. If A submitted the order to bid at 12 before B, right? So if like, so if the ordering was like A submits, followed by B submits, it should also follow that if someone trades against the order book, A gets filled before B does, right? So that's price time priority. You're ordered by price, and you're also ordered by the time at which the order was placed, right? So the way that the fill would happen, right? If someone were to like go into the order book and sell 50x at $12, what would happen here is that A's order will get removed and matched instead of B's order. So there's an explicit way in which all of the orders that are placed on this structure are matched, right? That's FIFO, first in, first out, FIFO priority. This is based on price and based on time. Any questions up to this point where this all makes sense? Great. Okay, that's the context, right? This is what like Serum implements, and I'm going to talk a bit about how like that is actually represented on in like a data structure on chain. Okay, so the way that Serum represents this is that it uses a data structure called the binary trie. It's also referred to as a grid bit. We'll talk about that a little bit, but it's not super important. Does anyone here know what a trie is? Like a data structure is a trie? Yeah, well, it's a trie.
It's the idea of like if you want to see given like some initial letters, all the words that start with those letters.
That's right. So like what he said was essentially like you have some sort of alphabet of symbols, right? So you have like an alphabet. A has like a bunch of symbols like X1 all the way through Xn. These are all like characters, right? You can think about it like a normal alphabet, like A, B, C, etc. But maybe you also have like box, which points to X, and maybe you also have like boxer, which points to like E, points to R. Maybe you had like that or something, right? So the idea here is that you can like build a tree out of these characters, right? Like it's a condensed way of representing things, because like you can imagine if like 2 things share the same prefix, you don't have to store that element twice when you're like organizing the data structure in your program, right? So this is a trie over an alphabet of like multiple characters. It makes a lot of sense when you think about this in terms of like normal letters. But what I'm talking about here for Serum is that instead of using like an alphabet trie, it uses a binary trie where alphabet only contains the characters 0 and 1, right? And what you can do here is something pretty similar. It's essentially like a binary tree where every node represents like a value, right? Or really like every edge represents a value. So you might have like 0, 0, 1, 1, 0, 1, right? So this would be a trie, a binary trie over a bit string of length 2, right? Where every leaf node here represents a particular value, right? This would be like 0, 0, 0, 1, 1, 0, and then 1, 1, right? The especially cool thing about this is if you take these numbers and you represent them in binary, like base 2, right? The way the base 2 works is that you take the rightmost index of the number, multiply by 2 to the power of that index variable, right? So like I guess like this one would be like 2 to the power of 1 plus 2 to the power of 0, right? That's like how you represent it. It's always from right to left. If you represented these in terms of numbers, this would be like 0, 1, 2, 3, right? So a binary trie has this really unique property where if you store all of the values in this trie, ordered in this way, it's just naturally sorted. Does that make sense? Cool. That's like the basis of most of this, right? So the really clever thing that Serum does to make use of this data structure is that it represents the orders in terms of like a 128-bit string, where the first 64 bits, right? There's 8 bits in a byte, right? So and that represents like a price, and then the latter 64 bits represents like a time. And this is cool because like if you combine these two together and you throw this into this like trie object, you naturally have this like sorted ordering that you're looking for, right? So you can sort of say like, say I have like a price that was like 10 and a time that was like 0. I have a price that's like 10 and a price and a time that's like 1. It's definitely true that if I were to put this inside this like trie object, this particular price gets ordered before that price. And in this case, right, like if we continue and say like price is 12 and this is like 2, or maybe you have like, maybe this is 3 and then you have like 13 and this is 2, right? It doesn't matter that 13 got inserted before the 12 because the 12 has a lower price. It's ordered before the 13, which is also good, right? So this has the property that we want. It turns out that like if we just have an incrementing sequence number, right? Basically, you count the number of orders that ever hit the club, and you also like represent the price, right? This just uniquely is able to represent the offers. Pretty cool, right? For the bids, it's kind of similar, but instead of like doing it this way, what you essentially want to do is you want to like basically reverse the order of time, right? So what I mean by that is, suppose I had something like slightly different. So these are like, this is like all offers, right? Does that make sense? Any questions about like how this represents offers? Cool. Easy enough. So if you want to represent bids, the ordering is like opposite. You want the highest number to be first. So suppose I have like 15, 0, 15, 1, 15, like 2, 12, 4, 11, 3, something like that. Like in this case, right, what you actually want is you want this 15 to be first, right? But the way that you sort this is kind of weird, right? Because if we're sorting this based on the way of like smallest to largest, what will happen is that 11 is going to be first, and then 12, right? And then 15, 0, 15, 1, 15, 2, right? And like the way that you would process it is you would process it in reverse order, right? So really what you want is you like if you were to sort this in the old way, the order that would get matched first would be this one. Does that make sense? Or do you have questions about that?
Why would we match first?
Yeah, that's it. Yeah, thanks. So if you wanted to order this like the normal way, the previous way from smallest to largest, it would be like 11, 3, 12, 2, 15, 0, 15, 1, 15, 2. This is the normal way. And because we're processing bids instead of processing offers, instead of going like down this direction, we're going up this direction, right? You're going from like largest to smallest instead of from smallest to largest for bids, right? So like if you were to take this list and take the largest element, you would pop this one off and not this one. You actually want this one. That makes sense? Yeah. Right. Cool. So you actually want this guy instead of this guy. So what you do for the bids is this clever trick where you like take this number and you like invert it, right? You do some like special like bit math to invert this number. So just kind of like, I'm not going to go into the details there, but like there's some way to basically reverse this so that it works in both directions.
That's just so you get the offer that was entered first.
You get the bid that was entered first.
Or bid.
Yes, yeah. So this is just like a computer science trick that you use to get the bids to be ordered first, right? Okay, cool. So like this is like essentially all you need to know about like how Serum's underlying data structure works, right? And this is really the thing that's like kind of innovative.
With bids compared to the S, do you run into like a leading zero issue?
You don't.
Okay.
Because like I think like all of the numbers are unsigned, so there's no like 2's complement or anything that like flips the signage. They're all like positive integers. So like what essentially you do is you turn like a really small integer to a really large integer, right? So it's like you count backwards from the biggest number instead of counting upwards from 0. Okay, so that's the whole like underlying data structure of this. Does that kind of make sense? Everyone sort of understands how this like.
Jerry, is the binary try, it's very sparse, right?
Yes, it's
Does
sparse.
it benefit from the sparseness?
Yeah. So that's a good question. So it's a sparse trie, which means that like normally if you were to store the full binary trie of like size 128, so it's like 128. Quick math question: how many leaf nodes are in this trie? So if the length of the string is 128,
Hopefully 2 to the 128.
yes, you have 2 to the 128 possible leaf nodes, right? If you were to do this in the naive way, where you store every single node. Obviously, we don't do that. So like one clever trick that you can play is that like if an order doesn't exist, right? None of the nodes on that path are ever included. So like just imagine there's a way, like this is underlying, like this is your mental model of like how the order book works, but like also know that like say this node didn't exist, that also means that this node doesn't exist. So really the trie would look like this. So like one thing that you can show provably is that like every single time you add a new node, you have to like allocate the space for 2 additional nodes. I won't go over the proof, but like that's kind of the idea here.
So the value of the node is also on the node. So you get to it quickly and then you know what you're actually getting.
Well, yeah. So you have some intermediate nodes that you have to sort of traverse through first, right?
Of course.
Yeah.
So once you get to it. Yeah.
Once you get to like a leaf node, that you kind of know exactly what it is.
Okay.
Jerry, we have a question from the Zoom.
Yeah.
And this is actually a really good one. Is there a significant difference between a binary tree and the trie you're showing here?
The only difference is just like it's easier to do traversal, I think. Also, like it's pretty much the same. The really interesting aspect of the binary trie is that the path is also the key. Whereas a binary tree usually has like values stored on every single intermediate node.
Very interesting.
Okay, cool. This is just like some high level stuff like how like Serum works. I think the more interesting thing, like this is about like the extent of the like computer science stuff that I'll be covering is like how like this breaks in Serum, right? Because like in Serum, what happens is that you have this like blob object, right? And it roughly works like user deposits token A, right? So like let's just say that like it's like A USD because it's too confusing to think about otherwise. So you deposit A, and this sort of corresponds to like an offer, like a sell, or like an ask. And in the case that you like trade, so if this trades, what happens is that you essentially look through that binary trie for the bids, you match a couple of the orders, and then like the user gets back like USD. If it doesn't trade, then like A gets placed in the book. Okay, that's pretty standard, right? And the same workflow happens for like if you use USD. So the issue is that like the only way that you can operate with this is like by using tokens, right? So like all of this is like all tokens. And another thing is that like that's a little bit annoying to deal with, right? Or if depending on like whether or not you have all the capital or not, right? Is that like if you want to place a bunch of offers on the book or a bunch of bids on the book, you need to have that many tokens. So like if I want to sell like 5 BTC, I need to have 5 BTC and I need to like lock it into the contract and it will be there in the order book, right? There's no way to sort of like pretend that I have this thing and then settle the trade later. Like you need to deposit all the funds into that object, which basically like prevents you from having any sort of leverage when you use base theorem, because base theorem only operates on tokens. There's no concept of like having a fake position that you use to sort of margin yourself against. So like the token aspect of Serum makes it sort of impossible to, at least maybe not impossible, but very tricky to implement like derivative contracts on top of it. So there are a couple ways to go about this. Like the cool thing, right, is that the order book try that we talked about does not care about what kind of like object you're using, right? It doesn't care about whether you have tokens or whether you're just monitoring a position. So one thing that you could do is you can just take the try, use the try for representing orders. And then you settle the trade, and you settle and account the trade in another contract, right? Settle trade separately. So that's kind of cool, right? Because then what you can do is you can like use this underlying data structure to try to determine like what people's positions are, but you don't have any tokens that change hands. The only thing you do is you say like, oh, like if I have a book that's AUSD and this is like a perp, right? So this is a perpetual swap. What I can do is I can say that like, if I traded like X buys 10 perp, 10A from Y at like $100, right? So if that happens, you can sort of just represent their position changes, right? So for X, in this case, they get like plus 10A and they get minus $1,000. And for Y, they get minus 10A and then plus $1,000. Or just the counting, right? So the trade goes through against the order book, which is the same structure as before. But now what you do is you can just say like, oh, like these are just positions, like they don't have any, like we don't have any underlying tokens backing them. I can just represent how they change. Does that make sense? Yeah. So like you can do this to represent like any kind of like asset and position. You can say like, oh, like now I can be short, right? Because previously, like it's impossible in like Serum world to be really short, but it actually be short because you need tokens on both sides, and all the trades like will actually settle like after they're made. Here, like they settle into some sort of like intermediate accounting state, but you don't actually like withdraw funds until after like after the user sort of says like, oh, I have this position, I want to close it out and like exit it entirely. So it allows you to sort of do these like artificial like accounting measures, right? That's where the Dexterity contract comes into play. There's a number of different like derivative contracts in Solana. Mango is probably kind of the most common one. So I can talk about Mango a bit, but I think I'll start by talking about Dexterity, which is this thing that I worked on a little bit earlier in the year, which is sort of a way to sort of generally represent these like derivative contracts in trading, right? So the idea behind this contract is that you have different types of products that can be represented in order books, right? So like concretely, this could just be derivatives. So let's just say we have like BTC per, and then you have like ETH, and then you have like SOL, and all of these are like perpetual swaps. If you wanted to have these, which are not like real contracts, right? Every time you enter a perp position, you don't actually own an asset, you just enter to bet against someone. And then your position can either gain value or lose value based on what happens to the underlying asset. But the derivative itself is like kind of artificial. And you can just represent that with like positive and negative numbers, right? Because you're just like, oh, I'm short this perp, which means I'm like negative 10 like SOL perp or negative 10 ETH perp, et cetera. What that allows you to do is you can sort of like make trades against this, but like also have some underlying collateral. So essentially, it provides you the ability to like build like a system that could potentially like allow for leverage, where you're not fully collateralized, which is a tough problem in like the blockchain space. Because for almost every single type of smart contract in DeFi, there's some aspect of being over collateralized. Almost every single borrow lend protocol requires you to like put up more than the assets worth that you're borrowing in terms of collateral, which makes a lot of sense. And in this particular case, it's pretty similar, where you it's pretty similar in some aspects, but also different because like you're no longer working with these sort of these token things, right? Like these things are totally artificial and like they just purely represent like your change in So the idea is that you can like sort of put these together into one big group, one big file, and allow people to sort of trade across multiple different books and then change their positions, right? That's like the general idea behind this dexterity thing. Another really interesting aspect is that like all derivative contracts don't actually really exist. They kind of just function as this like weird thing where you enter an agreement with someone and that agreement will pay out in some way, right? So like we'll talk about like a couple of them, right? Like perpetual swap, like the way this works is that you have some perp book which tracks the price of some index, right? We usually call that mark. And then you have some index price which corresponds to the price of that asset. So this would be like BTC price. And this is usually like taken against some real life centralized exchange, right? Like you can take the BTC price from FTX or Binance or Coinbase, and then the market price would just be the price that the perpetual swap trades at, because that has its own order book. So like this would be like an on-chain club in our case. And this would be like an index price that's pulled from some off-chain club, but it's the same kind of idea. And then the way that like the funding is calculated is you take M minus I absolute value multiplied by some like funding ratio. And the signage of M minus I matters. If mark is below index, that means that like the long should be rewarded, right? So you sort of want it to go back to parity. You want the price of the perp to reach the price of the index. So if mark is under index, the shorts will be paying the longs. And if mark is over the index, the longs will be paying the shorts. Basically, you're rewarded for taking the side that brings the price of the perpetual closer to the price of the index, right? So this is what we call like a payout function. We can define a few other ones, right? So like another potentially interesting payout function is for options. So like if you have an option, let's just talk about call options. These are usually defined as you have some strike price X and you have some index price I. And you only really want to exercise the option if by the time of expiration, the strike price is less than the index, right? A call option basically gives you the option, but not the obligation to purchase some asset at price X at the time of expiration. So it only really makes sense to purchase that asset if I is greater than X, right? Because otherwise you would just buy the asset for I. So concretely, we can represent the payoff function for this as like maximum of 0 and I minus X. I guess we can, like, I think generally you represent this as like S or something. So we can do that like S or like stock price. This is the payoff, right? Because like if X is trading under the value of the stock price, you'll actually exercise the call option. That's the value of the call option at expiration. And if you're cash settling it, right? So not settling it in terms of the actual like, oh, like I purchased the option and then now I actually get, now I can actually purchase the tokens or the stock underlying. You would just, this would be like the cash settlement. Like this is the amount that you would like make. Yeah, what's up, Nick?
So yeah, I was just gonna mention this as the cash settlement, because you define the call option as the right, but not the obligation to buy the asset. Here,
Yeah,
you're
yeah,
not actually buying the asset.
That's right.
Is there a way you ever see physical settled options on chain or in the structure of Dexterity as it is now?
It's pretty tricky because I think if you wanted to physically settle it, you would need to have the underlying collateral also available. So like essentially what would happen is that if you had a BTC option, you would probably need to have 2 collateral pools, one for storing like USDC type, like some stable coin asset, and one for storing like the BTC token. And if you wanted to settle the option that way, you would essentially need to like dynamically change the collateral requirements as like the price of BTC changed. So that like becomes a little bit tricky to deal with. I think it's potentially possible, but also like far more difficult to manage in like an on-chain setting. It's a good question. Any questions up to this point? Cool. So like the kind of cool thing, the thing that like I think is like as an engineer, I like to think in abstractions, right? Like the abstract contract concept here is that like you can enter agreements that lead to people getting paid, or you paying other people, right? So like really like it doesn't really matter what this function is. You can sort of just represent it as like, oh, like some time has been reached, and like the contract like tells me that like this is the price I need, like the price that longs need to pay shorts or shorts need to pay longs, right? So like at some point this value just gets like known, and then like the contract is settled, right? So like the abstraction that Dexterity introduces is that like it doesn't matter what type of derivative or like instrument that you're trading. All you need some sort of like some product with a payoff function. It's just a defined way of saying like we've reached a settlement time, and at the settlement time, this is the amount that longs owe shorts, and that number is signed, right? So you can imagine that like if the number is negative, that actually means that shorts will be paying longs, right? So like there's some positive or negative number that gets broadcasted at some point in time that gets sent to this contract. This contract will know how to apply that balance to each of these users, right? So like say this was the situation where like X entered like this contract with 10A and Y entered this contract with negative 10A. Suppose like this A thing settled at like, oh, A settles, and then A pays, requires that like longs pay shorts. So L will send like, I don't know, like $1 to S per share of A that they have, right? Like that could be an example of a settlement. And what would happen here to the positions is that like, because X is long A, X will lose $10 minus $10 additional, and then Y would gain $10. And that's it. It's basically a way of saying, it's basically a way of abstracting away like the way in which you handle derivative or like any like financial instrument settlement. Like you have an ability to say that like this thing reached some terminal agreement, right? And that represents some like cash value. That value gets propagated to this exchange contract that essentially uses the same central limit order book for representing like accounting and positions. But after like the settlement occurs, every person with an existing position knows the amount of money to pay or the amount of money they're owed, and they can just collect that. And that's the primary idea behind this contract. It just builds a system in which this is supported. So the complexity here primarily comes down not to the fact that like you can do this sort of payment. It's like how do you manage things like leverage, like how much margin an individual participant in this exchange is able to like have, right? Like how much collateral do they need to post to do some amount of notional value? And also what's also kind of important is like how you manage risk. Like if someone is levered in some way, like someone isn't fully collateralized, how do you make sure that the protocol is solvent in the case that a certain price movement occurs and you need to liquidate someone's position, right? So those are the tricky aspects, right? So like what I described here is sort of like, this is like the how, this is like what it does. It's like it abstracts away this idea of instruments. But in order to really like process this, you need to have this, you also need a way of like managing risk, right? So like you also need a way of like saying, this is the overall risk of an asset or a position. These have like components like collateral and also liquidation. So like those aspects are handled in the contract as well, and that's exposed through like a generic interface. So like in Solana world, right? This sort of is composed into different programs. You have like a program that represents the DEX that allows people to sort of interact with some CLOB and change the positions that they have outstanding for these different positions and like cash balances. You have a contract that represents the instrument that's being traded on this exchange. So that's like a perp or a future or an option. And you also have this concept of like a risk program that plugs into the underlying contract, but does calculations against people's positions to make sure that they're still above water. And that's the overall idea for how this workflow works. Any questions? Cool. If not, that's all I have. I'll be around. So if you guys are interested, just if you're watching on Zoom, just message me on Twitter or Telegram. I'll respond. And for the people in the room, happy to discuss afterwards. Thanks.
Well, sweet.